troubled banks are about to deal a blow to the country's Millennium Development Goal of cutting its 40% unemployment rate. As banks struggle, there are hundreds of jobs on the line. Barclays, one of 6 major banks, has plans to cut staff by 5%. This includes 200 senior management employees. Staff costs at the bank in the third quarter of 2010 was half of operating costs. Kenya Commercial Bank, East Africa's leading bank by asset classification, is in the same strife.
This year, what we've done is to launch what we are calling a transformation program. And the transformation program is not about laying off people. It's about looking at our business and saying, who are we, where do we want to go? We've got a vision which says we would like to be a Pan-African bank, paraphrased. So we are looking at the journey so far and where we are today and how we can get to realize that vision.
Analysts argue that cost cutting is inevitable if banks want to survive and thrive.
Well, we know that Barclays are going to cut 200 staff. We know KCB is now reviewing that. KCB probably has the highest over-employment scenario, so I would expect something like 500 to 1,000 job losses.
The review that we are carrying out and where McKinsey and company are working with us over the next couple of months is really to look at our business and to say, we've done well. Over the last couple of years, we've seen very good profit growth, we've seen very good business growth, but we can actually get better. And so the people element is not the key focus. There will be outcomes which affect people.
The intense competition within Kenyan banking industry is forcing banks to trim excess fat.
Banks are not able to raise and match financing. So if they want to make a mortgage loan for 15 years, typically it's difficult for them to raise 15-year money. That's improving. But essentially they're running a lot of what I would call interest rate risk on their books. And they ran a lot of risk last year because the bond market went one way in Kenya and the banks all bought bonds. But you're quite correct, we don't have a sophisticated money market. The banks still are unable to raise matching asset and liability funding.
Our efficiency ratio, which is measured measured through the cost-to-income ratio, it remains above the market benchmark. We're sort of hovering around 60, the low 60s. Some of the market players in banking are somewhere in the 40s and in the low 50s, and we're saying, we need to get somewhere close to where the industry average is. And for us to do this, there are two parts of this equation. How do we grow our revenue? Because that is the denominator in this arithmetic. And how do we manage our costs better? Staff costs today are probably half of our costs if you look at our published results for 2009 or even September 2010. And so in dealing with the top line, we've got to get strategies that deliver revenue in markets where we are, in potentially new markets. In dealing with costs, we've got to look at the entire structure of our costs, and begin to find ways of dealing with them in a way that raises the productivity of the bank and ultimately results in better returns to the shareholder.
There are some banks who are riding the storm of competition. Equity Bank reported a 53% growth in profit before tax for the third quarter of 2010. Their employees are safe for now.
Equity seems not to be in that group or category of banking institutions. It's a young bank that is growing, and we consciously from day one tied our staff cost to productivity. So we have not seen any need or signs for that. So I'm not seeing us going to through that route now or in the medium term, because we have been able to tag productivity and reward.
The finance sector contributes around 20% of the GDP of East Africa's largest economy. This is just one reason why players in the economy will be watching the banks to see how they wriggle out of these hard times.